Thank you, and a very good morning to all of you who are tuned in to listen to us this morning. Thank you so much for taking time out on a Sunday morning to be with us. And on behalf of Aditya Birla Sun Life AMC and the week, it is my pleasure to welcome you this morning. I'm Matthew T. George, Senior Associate News Editor of the week. Today's webinar will deal with the topic is Be a Smart and Responsible Investor. It will cover three areas: investing fundamentals, smart and responsible investing, what and how, creating an impact in society through investing. This webinar is brought to you against the backdrop of the World Investor Week 2023. And again, welcome to everybody who has tuned in. It is my pleasure to introduce the panel this morning. Mr. K.S. Rao is Head Investor Education and Distribution Development for Aditya Birla AMC. He's been the linchpin who holds this show together from its very inception. I was just telling just before we came on air that he would have made a wonderful teacher or a professor, and Amitji was saying that is what he does, but on a larger scale with a bigger classroom. I always say that this panel is a very accomplished panel professionally, but more than that, they are wonderful human beings, and that is what makes them very successful in their professions. And Rao sir is a very good example of that. He is an IIM Cal alumnus, an MBA in finance, chartered wealth manager. His work with ABSL has been very successful. That in the Nivesh Manthan Nivesh Samman 2023, ABSL was awarded the best fund house for investor education, best on-ground investor awareness programs, best social media presence, and best print media presence. For this, we had congratulated the ABSL team last week as well, and this week they have another award, another feather in Rouser's cap, which is for her, which is a specifically women-centric program that ABSL had launched for empowering women in managing money. Actually, it's very wonderfully packaged with a leather diary and a lot of literature in it, and also a diary to keep track of investments for women. The award at the BFSI World Congress received Best Financial Education Initiative for Women in India. So it is also my pleasure on your behalf to congratulate ABSL and Rao sir for this wonderful achievement. And welcome, Rao sir.
Thank you so much.
Session. We have another awardee in our midst, and that is news that Rao sir just broke. The Financial Freedom Fraternity Awards. Our second panelist, Amitji, Mr. Amit Trivedi, was awarded at Mumbai last Sunday. So please accept our congratulations, Amitji, for that. Amitji, as Rao sir calls him by pet name, Karma Yogi, is the founder of Karma Yoga Knowledge Academy. He's an author, a speaker, a trainer, a blogger, and has been on this journey for a very long time. He is an accomplished author with many books under his belt, and the most latest one, which came out last year, was Money-Wise Perspectives for Women, which was written in cooperation with another of our regular panelists, Ms. Kiran Talang. And when you listen to Amitji, you will know that he brings in a dash of Bollywood, a little bit of cricket, and all that, things that the regular average Indian loves to bring in and hammer home financial advice. Raoji's specialty are his acronyms, as we were joking earlier, Amitji and I. And Amitji is his popular literature, movies, cricket, and all that. So my pleasure, Amitji, to invite you and welcome you this morning. Harshji, good morning. It is great to see you again with us after a long time, but still, because of WhatsApp, we are forever in contact. And Harshi is very kind enough to send me his columns on which he writes in Business Standard, very popular columns. As I said, they are wonderful human beings, and the problems that they discuss are so close to things that we face. For example, the last discussion that I had with Harshji was about Harshji's suggestion that if a house help borrows money, there should be some system within the financial framework to ensure that the money comes back to the person who lends it, so that they have access to credit and the person who gives the person's money is protected. And just as a random test case, I went to office and asked how many of you have actually lost money by lending to house help. Everybody had lost. So that is a common thing that happens. So that's what I said, these are everyday problems that people face. The credit crunch that, lower income families face is real. It is true. The money loss that middle class families face when they pay them out, that is also true. So Harshi's suggestion was there should be a bank standing guarantee in between. And I think Harshi will explain it later, possibly. Harshi is a chartered accountant, founder and former CEO of Apna Paisa, which was earlier apnaloan.com, director and former chair, Association of Registered Investment Advisors. He is governing council member of Sahmati and currently principal officer, Fee Only Investment Advisors LLP. As I said, he's a great writer and is on the media quite often. It is my great pleasure, Harshji, to welcome you this morning. Thank you so much for being with us. So this format, those who have been with us know, begins with a presentation by Rao sir, and then goes on into a panel discussion between the three of them. And then we have a Q&A session. You can post your questions and answers in the Q&A format here, and it will be answered later. We don't take specific questions about specific funds. That is something that we don't do. But otherwise, whatever possible, we answer. Also, the team, Anand and Mavina from ABSL, they'll be posting links of downloadables from ABSL. Please do download and use them. It's very helpful and informative literature. With these words, I'll stop and hand over to Raoji. Thank you so much, and I wish you all a wonderful summer.
Thank you so much, Matthew sir. Indeed, it's a great honor to be here, and thanks for your kind words to all of us. And we are grateful to Manorama team, each one of you, for the kind of support, whether Sri sir, Matthew, Aruman, and Sri Devi and Rahul at the back end. And at ABSL, we take privilege and pride with this association. And every month, at least one webinar, and then every quarter, at least one on-ground event, which is going on for years now. We'll continue this. I'm glad I'm joined by two wonderful individuals, Harshji and Amitji, and both of them are gurus. And it's my job is much more easier. And today for the audience, it's going to be very interesting because rather than a standard format of some questions, today I request both of them to, because it's the Investors Week, World Investors Week, they themselves as a guide themselves, and then the investors, they can share their wisdom. And welcome you all. Before I'll just quickly run through 10 minutes of this session about, and then we will have panel conversations. Then we can have all the questions what you are putting on the chat, preferably in the Q&A box. And later my colleague Mavina and Anand, they will be sharing some of the books, which you can have a free downloads. And it is very interesting books where it's the latest magazine of the Samruddhi, which is a personal finance magazine. It's a very interesting themes and concepts which are there. And then there are other books we will be sharing with you. And rest assured, next 1 hour, 40 minutes or 30 minutes, we will ensure that you will get your time invested here is going with a much better knowledge sharing. Much better equipped with you. And rest also assured, we are not here we are not here to sell any product that is 101% guaranteed. And with this, I'll just quickly share my presentation. Thanks, sir. Again, I look forward for this. Thank you all, and it's a great to see each one of you. And today we have over 4,000 people registered for the webinar, and we have quite a good number of people in the Zoom, and then we are on the Facebook Live. Whether you have joined through the Facebook or YouTube or through the Zoom, thank you so much for investing your time on a Sunday. And this is a theme. This time is this is the theme we are doing. This is from tomorrow to next 1 week. In India, we are celebrating World Investors Week. Globally, this is an international organization of the Security Commission, which celebrates Investor Week. In fact, it has already started. They started from 2nd of October to the 9th of today. It's 8th of October. 1st of October to 8th of October. And from day after, then tomorrow onwards, the SEBI is doing this, and there is going to be a very interesting conversations across the country, thanks to our regulator. And this is this year the theme which is given for the World Investor Week from the IOSCO, that is the International Organization of Securities Commission, is on the investor resilience. This is a theme which lasts over 3 years, which is on, which is predominantly post-COVID. Why we need to be much more resilient. And this year, little bit, they spoke about cryptocurrencies and sustainable finance and how we can get ourselves protected from the digital frauds. We will take it and probably we will have a lesser discussion of the crypto because it's neither a regulated stuff here nor we are interested on that piece to take your time out. And this is the, I know it's the, and it's this time there is a big theme which has also come is a smart investor does not solicit investment offers. It's a, I mean, we expect the investor to learn, and it's a educated investor is an empowered investor. That's what our regulator SEBI always says. And SEBI does a lot of good work in this space. And SEBI, in association with AMFI, from tomorrow, we are also celebrating at all the mutual funds in the country, doing lots of programs, and including Aditya Birla Sun Life Mutual Fund, which I represent. And there is also going to be a Bharat Nivesh Run, which is on the next, I mean, it's a 5 cities. On the next Sunday, it is on the 15th of October. This is in Jammu, this is in Jodhpur, this is in Indore, this is in Guwahati, this is in Trichy, and there is a website called U2 Run. You can, if you are belong to any of these cities, please go and register. It is going to be a lot of fun while you are making for run. And here, I mean, today basically we will talk about why we save, what is the savings, and why we are investing, and why we need to invest, and what is that protection ourselves and our lives, and protecting our wealth, and protecting from the frauds. Probably I call this as a new SIP for us today. We are doing a lot of investments through the SIP, but understand there is a back-end SIP. You save, you invest, you need to protect, and that will give that investor resilience, and that can give that can build that investor confidence from the all fund houses and industry. We intend to do that. And this is the regulator message: is informed investor is an empowered investor, and empowered investor can take those decisions. I mean, informed decisions. So that you are liable for what you are taking decision, and you are not taking the decision based on somebody's information. You are taking information in the decision on your own goals. And with us today, Harshji and Amitji, and Harshji has got a phenomenal clientele, and he got a rich experience of a lifetime advice. We can get to know what are those informed decisions you should take and what you should avoid. We will have those conversations. And today we will also have this session. Broadly, we'll talk about how the smart and responsible investor, how you need to become a smart investor. I mean, what is the way to become a smart investor? Are you a smart investor? Then what is a responsible investing? And how to make impact in the society through investing. You are investing for yourself, your family, for your goals, but is that giving an impact? I mean, can you create impact? Your investments can impact your life, and your investment can impact someone in the society or in the globally. How we can do that, that investment. And last but not the least, we are in the environment of a digital. And this morning I was talking to one of my friends from one of the banks, famous banks, HDFC Bank, and he was narrating to me the stories, what kind of frauds people are evolved. It's we need to protect ourselves, because there is, everyone is trying to get you, I mean, your money in a different way. What is that you need to do? How you need to become resilient? What is that you need to do? We will have these conversations probably next 90 minutes. This is going to be an engaging conversations, and you can also put it in the chat box and Q&A. As far as possible, we will take your questions to the best possible. We will try to get answers. And then looking at what is that smart investor? Who is the smart investor, and how that investor resilience is coming in? And in terms of investor resilience, what is that smart investor need to do? And there are two things which we struggle. I mean, when there is an inflation, there is a volatility in the market. How we can focus on the impact of inflation? We call, there are three things to learn in the financial literacy. The ABC of the financial literacy is DIP. This is the delayed gratification. This is an impact of inflation. Then there's a power of compounding. How that can work and impact, and what is the real rate of return which can supersede your investment performance? Which is the asset class you need to be? And what are the various asset classes you need to understand, and why the asset classes understanding and asset allocation is important? And what is that, why you need to diversify your assets? There is a mutual funds provide you the diversification, but diversification for your assets, how you need to protect that, can how protecting from the losses, protecting from unexpected events. For example, yesterday there is a war broke out for Israel and and the Palestinians. It's a Hamas. How you can look at, I mean, what is going to impact? You don't know. We can't predict what can happen tomorrow morning. But how do I sustain those shocks? then how I can weather these negative financial shocks, and what is that emergency fund I need to keep. During pandemic, we spoke many a times. We need to have that emergency fund, but we tend to forget and we get back to the routine, we get back to the normalcy. And what is that way? And there is a risk exists in every asset class. What is that risk? I can understand how much risk I can take. This all will lead you, if you can understand right, you can answer it right, you get that investor resilience. So that it's not, investor resilience is about a successful investing. It is not just about avoiding the losses, but it is about bouncing back from them. It is about learning from them. It is about the committed to those for a long-term goals, so that you become resilient. And all that what we need to do is plan for your life's unexpected challenges. This morning somebody sent a wonderful WhatsApp message. You need to prepare for the unexpected things to happen and expected unexpected disappointments to happen. Then either way, how you are making it happen, what is that you need to take, and what kind of debt you need to take, what kind of loans you are allowed, what kind of loans you need to avoid, what kind of temptations you need to avoid. Probably this is a season of festivals. There are two major e-commerce sites which they have their own festival time. Are you buying things which you don't need, impressing the people you don't love, and spending the money which you have not earned? Just need to look where what is important for me. Then you need to buy what is most important. This is where we'll talk about the impact investing, and which is the investment universe, what are the available, and what are the investment objectives for yourself, and when you are investing, what you need to look at. Second parameter we look at is sustainable finance. And sustainable finance, the smart investor is the one who's like, today we are living in the global world. We talk about in G20, all of us have seen as a theme, Honorable Prime Minister, which you spoke about, Vasudhaiva Kutumbikam. We are a world as a family. And if we have to coexist and we need to get all of us together, we need to have that responsible investing. There's an impacting investing. There's the ESG investing. It is environmental, social, and governance. Not only we survive now, our next generation can live, survive, and thrive. And that's where we need to look at that impact. How I need to review my disclosure. There is a ESG is a theme which is becoming popular. And are we there? Are we investing it right? And what is that responsible way we can look at? What is an approach we need to follow? And what kind of opportunities we have? And how we can move forward? And what are those three buckets of environmental, social, and governance we need to look at? Whether it is a biodiversity, whether it's a gender diversity, or it's the we can look at ourselves right governance. Not getting into the frauds. How we can get away. How we can get ourselves insulated. How we can sustain for longer term. How we can get that resilience right. This is about sustainable investing where we can look at. And the last but not the least is this is hard-earned money. Every rupee matters for us, like every drop of water, and we need to ensure it is rightly invested. And we should not fall prey to any of the scams. We can see the people who get into many of the scams with a minimum care, minimal understanding. We need to understand, because we are in the mobile world. One link can swipe off your entire money off. One connection can take your entire money off. What you need to look at? Then you need to take that advice from the right investment professional, a licensed professional. And we need to put little energy, little effort to research where we are investing, why we are investing. And let us also understand the financial world runs between two emotions, greed and fear. Between the greed and fear, how I or myself should not fall prey to it. Then you can't get rich quick. There is a wonderful big book written by Dhirendra Kumar of Value Research, The Boring Way to Become Rich. If I'm putting my SIP for 25 years, it looks nothing is happening, but suddenly I create a lot of wealth. And that's avoids get rich and you can't lose schemes. There is nothing called free lunch, nothing called get rich quick. It is a temporary phenomena. One we need to understand. Don't fall prey to it. In fact, a lot of people whom I met in the last few weeks, those who are the victims of F&O markets, which they don't understand. I think, last week I was in a Goa and I was talking to someone and he has lost little over 1.5 crore rupees in the F&O market. And he come back and telling me in the jokingly, sir, my future is lost. Don't have an option. That is the futures and options if you don't understand. And, then, in the financial world, sometimes distrust anyone who tries to pressure in making hurried investment decisions. Probably somebody is putting a lot of pressure. Today is the last day. Tomorrow you will missing the bus. You are a FOMO. Probably that's a conversation you can put off, and never feels rushed to take certain decisions. Take your decisions with your own financial advisor. Take your calculated call. Have a family conversations, and then you need to take care of how this digital distraction can happen, and how you need to, what is that you need to protect yourself, what can be there on your mobile when you are using a UPI, what cannot be there. Can you put only small money under UPI and rest of the things you protect it? Can you operate two bank accounts separately? They talk to your advisor. They can guide you in a way very differently, and depending on your, I mean, then there is a payment mechanisms which have come in, which will be taking out your money, and you need to be very careful. Even sometimes instead of 10 extra, you put your, instead of 1,000, you spend, you transfer 10,000. You realize later your account has gone for 10,000. You need to take those stuffs into this. And second, last is, you don't disclose your personal information, your PAN, your Aadhaar. That's just ensure that is yours, and keep those strong passwords, and keep a backup of those passwords somewhere where you know it and where you can constantly change it. And you can have uh, avoid totally unsolicited advice and get your own financial advisor, get into your own financial goals. And and whatever is available on the Google, you don't need to have the information to be trusted. What you need is the most important. In fact, I have my physician who says to me, if you have Googled and come, please don't come. I mean, that's I mean, because when I am going to him, I need to go. He is the much available information to me. What I Google is a place of information. It is a larger stuff. But what I need, my doctor knows. Similarly, your wealth advisor knows. And this is where you need to smart investors. For me, the SMART is an acronym. Normal SMART is specific, measurable, accomplishable, and reachable, and the time frame. But here, the smart investor, if you want to become a smart investor, you need to have a sustainable investment. Yes, I mean, where you are investing, and you need to ensure how you can manage your volatility of the markets, how you can manage your volatility of your own emotions, and what is that right asset allocation is A, and R is your risk versus returns. I mean, how much risk you are taking, what kind of returns you are expecting. If you are expecting with a little risk, more returns, and vice versa, just understand how the trade-off can work. And time in the market, not timing the market. It's a time in the market is you stay invested, whether it's the SIP route or financial goals, goal-based investment. That's where you can become a smart investor. And and there is also a social responsible investment. You also have a responsibility for yourself. You have a responsibility for your family. You have a responsibility that will be done with your right financial goals. You sit with your financial advisor. You sit with your family. Write your goals. This World Investor Week, take time and how you can spend this week. What are your goals? Are you on the track? Whether you are right goals, talk to your advisor. And this is after 30th September. It's the first, after you just evaluate last 6 months, how your investments have performed. And then, are you prepared for unwanted eventualities like the war broke out? What can happen? We don't know. And, that's those things. And end of it, you can take care of your well-being. And last but not the least, it is like, we are here. We are, like, as I said, it's a Vasudaika Kutumbikam. You are responsible for yourself, and you are also responsible for society. Part of it, we are also giving back to the society, investing for the charitable causes. That can also be your investment objective. And the investor resilience will come when you have a balance through the market fluctuations, like we have called a balanced advantage funds kind of it, and then sustainable investment. And always, have a goal-based investment, but understand the technology full, so that you won't fall prey to the you won't fall prey to those misleading endorsements, misleading advertisements, and misleading frauds. I know today there is a different world. I think we get normally the influenza, but today we have a financial influenza. There are financial influencers which you don't know what is an interest. If I go to the YouTube, somebody opens says, I had a holiday in Mauritius. I don't know. I mean, how much. Don't go by those things. If he had a holiday, it is his life. You can't just get lured by it. You can go holiday with your money and with your things and with your right way of investing. Don't fall prey to these influencers. And that's we get an influenza today. Like, I'm struggling with my viral attack. This is another viral attack on the channels. These influencers which can put you onto it. You need to be cautioned against them. And the simple logic: focus on your destination. Your goals are important. Take those navigation tools from your advisors, and adapt to the changing weather. Things may change, how you can get there. And there's a clear surveillance. I think my friend Amit has written a wonderful book called Investment is a Roller Coaster Ride. Likewise, you need to surf yourself in the rough waters, and you should have a patience. You should have a sailing will take some time. During the turbulence, stay back, don't jump out of the water, and don't get into drowned out it, and don't enter into the risky waters. Take all the precautions possible, and ensure inflation and volatility are continuously going to there. You can't control, you need to manage. You can't control inflation, but you can invest in those investments which can manage, you can get more over inflation, hedge against inflation. And volatility, it is like, can you manage, can you benefit from it? Look at how that can be benefit from it. It is like, every drop of water is most precious, and every rupee of what you are earning is also most precious. Ensure it is rightly invested, not lost. And no, in this industry and mutual fund industry has proved SIP is the best way to navigate the market volatility. It is a simple investment plan. It's it's a systematic investment plan, but it is very simple. And if you have done how that SIP over a period of time, it can weather the market turbulence, it can stay put. You can get a rupee cost averaging, and over a period, you are automating your savings, and it's getting automated wealth creation, which is happening. And over a period, it is proved that whether you can take this data, how this has overperformed, how that has given, this is an asset class which has given a good returns. SIP way of allocating has given a very different returns while taking care, optimizing your risk. And asset allocation is the most important key, and you need to understand what kind of asset allocation you can do, what works for you. In the bull run and bear markets, we have a different kind of mindsets. You need to avoid those crashes during the bull market, and you need to start during the should not stop during the bear market, and you need to continue. And as I said, please stay aware from this influenza and this phantom riches, and just get there. People who create a scarcity that you need to invest, and all these advertisements are meant to brainwash you to take those decisions very quickly, which you need to avoid. And then ensure that you don't disclose your prime data, whether your PAN or your Aadhaar to someone, or your account details. And then you have a Reserve Bank of India and SEBI has done phenomenal work. And what you need to do for yourself, you can just visit their websites. And it's in Upanishads, it said Suvin Yogat Samruddhi. When you are investing, invest in a right path which can give a samruddhi. And wishing you all be a smart and responsible investors, which I can stop here. And then we will have a conversations with our friends Harshji and Amitji. Thank you so much, Harshji and Amitji, for joining. And it's like we will have some quick conversations around. And I'll start with Amitji. And
Sure.
Indeed, both of you have done phenomenal work. Amitji, first of all, my congratulations to you for the last week award. And second, my congratulations to you for your new association, one step at a time. And even that is more required for the investment too, one step at a time. That requires in life too, one step at a time. And only you step up, don't step down. And give a pause, but don't last. And Amitji, with the theme this time is investor resilience. And we are talking about, even a couple of years back, we spoke about investor resilience. With reference to specific investor resilience and the changing the landscape, markets are changing faster. Can you throw your ideas light around this? And then we can look forward.
Wonderful. And good morning to everybody. Thanks, Rao sir, for this wonderful words. And thanks, Matthew sir, for great introduction. The word resilience, financial resilience. So when IOSCO decided to include this word resilience in the theme for this year, I was searching through some of the papers, and Asian Development Bank has issued a report where they defined resilience. One is to sustain the downturns or face the downturns, and second part is the ability to get up after you fall. So these are two words through which they've defined resilience. And in terms of financial resilience, the fall can happen in multiple ways. Incidentally, my career in financial services also started on that note. When I joined the corporate world, I saw a lot of people were losing their night's sleep after investing, which according to me was a big question mark. I was unable to understand. And then I started meeting people, met a lot of good teachers, read a few books, and realized that people are afraid of losses. And that fear largely comes because we are thrown in the water called the earning world, and we are not taught the swimming. You're not taught swimming, how to manage that money. And everybody needs to manage money in some fashion or other. a lot of times we delegate that task to certain family members within the family, assuming that they are better swimmers, and which also may not be true. And in such a case, then I decided that if I were thrown in water without being taught how to swim, my instinct would tell me I have to float. I have to ensure that I don't drown. And in the world of investing, that's the lesson I've taken. If you know how not to lose money, you learn how to invest well. Now that I'm just mentioning that because that exactly is where resilience comes in. If I know the avenues for losing money, I would prepare that safety net in a much better manner. You mentioned a few things. There are financial frauds, but then at the same time, there are investment risks. And beyond that, the biggest risk is, as the Amrit Bindu Upanishad says, Mana eva manushyanam karanam bandha mokshayo. So it's the mind, my mind, which is the problem for bandhan or mukti. I mean, that's the cause. So the losses arise largely because of the mindset than anything else. Shortcuts, for example, the pressure to take an action without sufficient research. These are some of the traps that we fall very regularly. And what a beautiful coincidence that World Investor Week and all the shopping festivals are coinciding. I mean, in that period, a smart investor, you rightly said, has to make a choice which side of the fence you want to be, or you want to keep your fingers in both the bowls, so that you spend responsibly and you invest responsibly. And that's the key. And that resilience needs to be built through proper understanding of two things. One is the subject of investing, and second is our own mindset. The subject of investing is where the financial literacy, financial knowledge comes in. And I mean, you also invited many spiritual masters here on this platform, which is the week, where they have told us about how to take care of those vulnerabilities of human mind. I think if we look at that combination, our resilience can definitely go up.
So much, Amitji, for a detailed, the message, and I love the way you convey how that resilience. It's a bouncing back and quickly coming there and avoiding the losses, or withstanding the losses, or how much loss you can take. Taking this theme further, it's Harsh sir, kudos to you, kind of work you have done in this advisory field and the wisdom with which you come. And congratulations for hosting a wonderful conclave 3 days back, and it's the Financial Planning Day, which is celebrated on 4th of October. And kudos to the great work you have done for the financial planners in India itself, across and the way you are those beginners of, 2005 initial financial planning certified people who have created the 18 years now. I think still the momentum is yet to start, and it was fantastic work. And taking that year, since your focus was always on a financial planning and always on the goal-based investment, taking the clue what Amitji said about resilience is avoiding losses. But there is another way of it, looking at a broader picture, have a goal-based investment and financial planning. Rest of the things can happen its own way. I don't have a control. What I have a control is my own goals. And what I have a control is approaching my own advisor. And what I have a control is spending time with my financial advisor and spending time with my family too on the broad finance plan. What is your opinion and your wisdom around this?
Thank you, Rao Garu. Thank you for those kind words about the profession. And as you rightly said, the financial profession has been now at least more than a decade old. And we still probably, licensed financial planners are probably maybe 400 or maybe 500 in the country, totally 900 investment advisors. And that was one of the biggest things that the association raised with the SEBI chairperson, and we will place those things in the domain. And I think very clear, the message from the SEBI chairperson was clear that we need 1 million good advisors. And I think how to get to that 1 million good advisors, that role will have to be played by multiple people. It will have to be played obviously by the regulator, obviously by the profession, but also obviously by the investors. Because without the investors, what will the 1 million advisors do? Now, one of the recurring themes that we hear, and I am digressing a little bit for a reason, and I will connect that up, is that people don't pay for advice, right? And that was something that the Honorable Chairperson of SEBI herself mentioned, that that is the feedback that she gets. I'm sure through mediums like this, when we talk to pretty smart investors, and there are 135 or 136 of them right now listening on a Sunday morning, I think the message that when you pay for good advice, when you pay for advice, you will tend to get good advice. When you start paying for advice, the good advisors will come on top. So I think that can be the smartest thing that you can do. Okay, because I mean, just take anything else, right? If you don't pay for good doctors, the doctors will not, people will not like to become doctors, right? If you don't pay for good health, somebody who helps you achieve your health goals, those coaches will not come up. Okay, so the key is that it is as much the responsibility of the investors as it is of the profession and as it is of the regulator. I will just do two things about the smart and responsible investing, and very sort of quickly. Smart investing, people confuse, according to me, a lot of people confuse smart investing with earning good returns. That's like saying, the guy who earns good return is a smart investor. Okay, is that so? So if I compare that with, say, health, you don't start doing exercises, you don't go on a crash diet. The results of that without a plan, what do you want to do? Why are you undertaking a health rejuvenation exercise? What's your goal? You want to lose weight, you want to look good, you want to impress your girlfriend, you want to make sure that you're around for your family, right? When you grow old, that you are around for your grandchildren's college functions, for their graduation. That can be a function. You want to drop your blood sugar level, you want to drop your blood pressure levels. There can be multiple goals, but till you know why you are doing what you are doing, you will never be able to hit upon the right road. So a person who loses 10 kilos in 1 month is destined for problems, unless that was his goal, unless that was part of his plan. So I think this fact that people don't talk about what they want to do, why they want to do, the why. Okay, I think that's very important. Second is advice, and you've touched upon it. I'm just going to sort of say the sort of same things. So Google can be a great ally, but Google can be a deadly enemy. And when I say Google, I mean all the chat GPTs of this world, or all the things that help gather information for you, because there is nothing more dangerous than half-cooked information. So would you even try to manage your illnesses or even your health wellness on your own, just by reading, just by gathering information? You would need access. You would talk to somebody who does that for a living, who takes professional responsibility for whatever he or she is telling you, who takes the trouble to find out why it is that you want to do what you want to do, and then gives you trade-offs of the various routes that you might be wanting to consider. Now, that's one role. Advice is one role. The second role that such an advisor plays is a nudge. Think, I have a coach who comes home every day to sort of make sure it is his ring, and I know that he is going to ring at 7:15. That makes me get up at 6:45 and be ready for him. That's the nudge that he gives me. He keeps me focused on my goals. Kiraj, you had said you wanted your HBS1AC to come down. It's now come down. What's your next goal? You have achieved what you wanted to do. Are you saying that's it? You just now want to maintain? Do you want to end further? Do you want to go for your second goal? Third, so I gave him an expectation that I want a six-pack, right? So now he asks me, Ki, Harsh, do you really want a six-pack? What will you do with a six-pack? You are not a Salman Khan, right? So what will you do with a six-pack? And I think this keeping in check the right expectation. Oh, you want a 20% return? अच्छा करोगे क्या सर? 20% return आ गया तो आप क्या करोगे उन पैसों का? You focus it right back on what you would do. And I think this combination of being smart, knowing what you are, why you are doing what you want to do, taking advice from the right sources for the right reasons, and using that advisor well. And that's where Google is an ally, because you get so much information. Okay, use that information, funnel it to your advisor, and the advisor will give back whatever is their view of whether that applies to you, how it applies to you, etc., etc. So I think smart and responsible are two sides of the same real coin. You can't be smart without being responsible. You can't be responsible without being smart.
So just want to add a couple of things. First of all the Google, etc., whatever platforms are available, and Harsha beautifully mentioned that it can be your best ally, it can be your enemy also. One thing that I always remembered and keep reminding myself, and for that purpose I'm speaking so that it's a reminder for me, that Google is a search engine and not a research engine. So you search a lot of information, collect it, but somebody's got to do the research by sifting through that information. Otherwise, there could be a lot of answers, and even Google can't tell you whether the answers are correct or not. So that's one. And second, on the need for the advisor, and I'll quote a beautiful incident from the Mahabharata, where just before the war, Pandavas and Kauravas went out to meet with various allies. And at one point in time, Arjun and Duryodhan simultaneously land up at Dwarka in front of Lord Krishna. And there he says, you can either have me who will not fight, or you have my Narayani Sena, which is among the best in the world. You make your choice. Arjun picked up Krishna, Duryodhan picked up the Sena. We know what happened eventually, because it was the same Krishna, an advisor, who kept Arjun focused on the goal. When he dropped his Gandiv, he says, this is your duty. This is what you are supposed to do. Now you can't back out after entering the battlefield. At various points in time, he kept nudging Arjun, ensuring that he's focused on the goal. We don't really know much about what role the Narayani Sena played, because the Sena was there. And this Sena I would call a portfolio, various investment instruments, various mutual fund schemes. But in the absence of a clear goal, in the absence of an overall strong plan, that Narayani Sena could not deliver. I think that need for an advisor, that need for an advisor, the role an advisor plays often is not understood well. So I thought better to quote this example.
What a lovely analogy. I just wanted to add one thing. What a lovely analogy that was, Amit. The one thing that you probably missed is that Krishna gave Duryodhan the first choice.
Right.
Because when he woke up, Duryodhan was sitting in front of him and Arjun was sitting behind him. And Duryodhan's he got the right of first refusal. Okay. And so in an investor world, you choose the good investment, right? The best investment, not good. Nobody goes for good. Everybody wants the best. So you go for the best investment rather than looking at somebody who can advise you on not just investments, everything.
Everything.
Two gentlemen around, it's always a conversation which can be more insightful. Nothing to moderate any conversation. The conversation itself can get into a very insightful. Thanks to both of you, and thanks, Harsh, at differentiating smart investment and responsible investing. I call it the SIRI, the Siri, which you can create. Smart investment and responsible investment. Probably I'll take a clue from Amit Bhai, and Sarathi in your investment SI. Will RI reaching your investment goal that can give you the true Siri for the life. And that's thanks to both. And coming back, Amit Bhai, this is a conversation, and the three themes. One of the theme is also a sustainable investment. And sustainability, we understand in the broad perspective, we are confined ourselves on the ESG investment. And sustainability can have a much bigger, one for myself sustainability, my family to sustainability, and global sustainability. And ESG is becoming a big theme across, and ESG is going to become the theme, and it's going to impact every one of us, and how you need to fix within that parameter of environmental, social, and the governance piece is concerned, because we need to coexist, we need to grow together, and there should be a governance mechanism where there is no fault. I can comfortable, like if I come from a Bangalore, I have a choice of seeing one crashing, one going up kind. Plane can crash, other Infosys can grow kind of it. That's a way. But what is that investor need to look at this, and in the changing landscape, how this ESG as a theme can work for the investors?
So I don't know when the entire movement for ESG started. But again, sometime back we talked about the Mahabharata. Let's now talk about the Ramayana. This story about Maharshi Valmiki's previous avatar, where he was, a robber in the forest, and he used to rob the passengers, and then that's how he used to feed his family. The family had no problem taking the support from him, but when Narada Muni asks him that go and check with your family, will they participate in the sins you committed? And they said no. So they were not investing with Maharshi Valmiki, they were only taking the dividends. Now look at this, and that way his family was not performing ESG investing. It is not responsible investing. When you see the world getting into problems because of various environmental reasons, when you see governance norms being flouted, when you see societies being neglected or taken for a ride, do you really want to participate in those activities? If you don't, and that's how probably the origin of ESG started. If you don't want, then avoid the companies which have lower score on ESG parameters. Somebody polluting the world, do I want to support that? Somebody, there's a term in the United States where they call sin investing. All these sin-related businesses, the casinos and tobacco and weed and marijuana, everything. Do you really want to participate in that? If you don't, then principally value-based, you decide to invest with ESG themes, the companies which are behaving responsibly. I don't want to give my money which can be put to wrong uses. It's like, in the movie Diwar, Amitabh Bachchan says, "मैं आज भी गिरे हुए फेंके हुए पैसे नहीं उठाता." I don't want to take that फेंके हुए पैसे. I want to earn with respect. Now, ESG has three components: environmental responsibility, social responsibility, and proper governance. Governance is not about the governments of the countries. Governance is more about the governance within the company that you are investing with. How they behave with as a company. They don't take shortcuts. Is the company evading taxes, which is a bad, which is a very wrong way of increasing profits? Socially irresponsible. Companies selling guns when there's so much mass shootings in schools in the United States. Do you really want to give your money to that? Or, as I said some time back, companies which are polluting the world, do you really want to support those? Take those decisions. And that's where some of the companies, some of the mutual funds are taking initiatives, and they are ensuring that they are looking at these scores, look for those things. Otherwise, anyway, I mean, there are recently SEBI also came up with a paper allowing more ESG related mutual fund schemes. Look for those. That could be an idea. The point really is, put your money where your mouth is. What you back, give your money there, otherwise stay away. Sir, you're on mute.
You're on mute.
Yeah, thanks, Amitji. Thank you so much for it. And it is a very well explained on the ESG in a simplified way. And moving from the ESG to the equity investments, which is a hot topic always. And there is also one interesting question which has come from the one of the participants, which I will take along with this simultaneously so that we can answer simultaneously both. As sir, this question is today, the equity investment is becoming very popular in India. And over last 3 years, definitely there is a traction which is becoming better. Still, I mean, the percentage wise, it is much minuscule, and SIPs created some momentum, and that momentum is catching the retail investors. And here we seek your guidance with your experience. What are that investors needs to keep in mind while investing in equity? And do they need to change their strategies depending on the market cycles? That's a question to you. And I will also add to that question the very relevant question which has come from the one of the participants, Mr. Madhusudan B has written. I mean, he's asking, equity is it not equity is an overhyped asset class, as there is a lot of euphoria building up around as if markets will never fall or go down, and this pushing many first-time investors to take undue high risk without real understanding risk and scary situation, which I feel. So what should the experts in the panel here today feel, please? Looking at these two clubbing, and very interesting question from Mr. Madhusudan. And, no doubt it is an interesting asset class, no doubt we need. And there is also another apprehension, it is overhyped. I mean, what is that we need to take as an investor?
So let me answer the second one first. It's a very interesting question about equity being overhyped. Mr. Madhusudan, you are absolutely right. Equity is an overhyped asset class. There are 3 other asset classes that are as much overhyped. That is fixed income, that's gold, and that's international securities. So we have now 4 asset classes that are extremely overhyped. What will an investor do? That was slightly facetious answer, slightly off the cuff answer. My point is, all asset classes are underhyped or overhyped at any given point of time. It's a matter of timing. This also answers the first part, that if you are clear why you are investing, if you are clear where you want to reach, you will plan your travel accordingly. Where you want to reach, what resources you have, that will determine whether you will go by bullock cart, whether you will go walking, you will take a car, you will go fly, you will take a helicopter. Do you have the resources? Do you want to reach that fast? What is it? Where is the place that you want to reach? I think same applies to asset classes. Equity can be overhyped at times. It does not matter. And that's why the mutual funds have done such a wonderful thing about systematic investment plans. It does not matter. Make inertia your friend, right? By nature, human beings are loath to overcome inertia. Newton's law of inertia applies to human behavior as much as it applies to physical objects. Make it your friend, give it that initial push, start that set. After that, let inertia take over. Don't keep watching what's happening. Okay, there will be periods when it is overhyped. Does it matter? Do you need the money? No. There will be periods during which It will be really below the amount that you have invested. Do you need the money? No. If you have not looked at it, it does not bother you. Now, when you need the money after 10 years, 12 years, if you go back and look what that has achieved, and that's true of not just equity. I mean, it would be true of, for whatever is the purpose, there is a fit vehicle, and it is always a mixture. It's never one asset class. So by themselves, they are all overhyped. But together, in some combination, so by itself, a finger is not powerful. In fact, it can cause problems. Taken together, it's a feast that delivers the punch that you need. So I think understanding that, and again, I go back to the first thing. What smart is not about getting the highest return. This question stems from, oh, I'm not a smart investor if I don't get the highest return. Highest return over what? Do you really need the highest return? Can you handle the inevitable pushback of a high return? Return, always substitute the word return with risk. When you are asking for high return, you are asking for high risk. Risk means loss of capital. So higher the return you seek, higher the risk. So my point is to be smart. You have to look at asset classes in a combination. You have to keep doing it systematically, but most importantly, you ought to know why you are doing something and have a plan for reaching there, and have a good advisor who can manage your expectation, nudge you, and make sure that that asset allocation, how much of each asset class is there, is just right for you.
Yeah, Harish, Amit, you want?
Just wanted to bring in Mr. Amitabh Bachchan here. In the movie Kalia, in that jail, there's this famous dialogue, "Hum jahan khade hote hain, line wahi se shuru hoti hai." But that was Mr. Bachchan. Most of us in the investment world, my observation says, jahan line khadi hoti hai, wahan hum khade ho jate hain. Right? And that links to this overhyped asset classes so well, because what is overhyped? Do I stand in that queue? The moment I stand in the queue, because of the actions and opinions of people ahead of me, the price moves. So if I am a buyer, I end up buying costly. If I'm a seller, I end up selling low. And that's the surest way to lose. So how do I ensure that hum jahan khade hote wahi hamari line hoti hai? And that's what Harsh sir was mentioning about your financial goals. Each of us have unique financial goals. If we stand up in front of our financial goals, that's our own line. And then you are not going towards what is overhyped. You are going what can help you reach your goal.
Thank you so much for it, and thanks for a wonderful question, which is come from Madhu Susan. And Harsh sir, you put it very nicely, and thanks for those. I'm bringing in Amitabh Bachchan. I mean, joining in those lines. But I would like to add a little more with some data, whether it's a hyped asset class or not hyped asset class. I mean, look at in equity. I mean, we are talking at Amrit Kal for the next 25 years, but let us go back to the past 25 years. If I can look at Nifty in terms of CAGR in the last 20 years, as of 30th September, which has given little around 15% CAGR. I mean, in the last 20 years, I have seen, we spoke many times, hyped asset class, avoided asset class, not to enter asset class, and the painful asset class. But those who stayed invested, those who have continuously put it, whether it's the SIP route or whichever the route, if you are stay invested, then you got that 15% CAGR. Hype, don't go by it, but you can continue what you can do it. And during hype, don't hike your investments. Then, stay back there. And during the same period, inflation in the country is around 6.5%. And let me get back to the just previous 5 years of and when I took 15% return CAGR 20 years, but in the last 5 years, CAGR is just 11.7%, whereas inflation was around 5%. Means, still the hyped asset class has given double the return of the inflation. Then, there could be a period which can be if I can talk 2020 and April, then it could have been a negative. But if you stay invested, it's a positive. All that it is in your investment, whether it's a hyped asset class or not hyped asset class, follow your basic fundamental principles. Like, there is a virus in the world. What you need to do, you get your own immunity. How you get yourself immunity when you are investing in such an asset class? Invest for your goals, invest for the long term, and invest with an advisor so that he or she can be with you and an emotional connect, and have that disciplined approach of regularly investing. And regular investment and professional advice can make worlds of difference, whether it is a hyped asset class or not hyped asset class. And hope we have clarified if you have not confused. And getting back to you, Amit Bhai, and when we talk about mutual funds, when we talked about various asset classes, we talk about the diversification. And what is your idea about diversification? You can share with the viewers. And you have written quite a good number of books. And one can be the roller coaster, how diversification can help the people. And mutual funds are a great tools of a diversification. And how you can simplify that, you can guide the audience.
So first of all, I'll borrow from what Harsh sir sometime back mentioned about one finger, what it can achieve versus when the five get together, what it can do, the feast. Now, that's really the power of diversification, that even when five weaker but different investments come together, the portfolio becomes robust. Okay? And that's really the basic principle behind diversification. However, the word diversification is derived from diverse, so it better be diverse. A lot of times what happens, and we've seen it in the past, like in the year 99-2000, a lot of people thought that they were diversifying across various technology companies and technology funds. In 2005 and 6, a lot of people thought they were diversifying across infrastructure companies and cement companies and power companies and such funds. So that's only limited diversification. It is not enough. In riding the roller coaster, as well as many, other observations. So riding the roller coaster, I mentioned about a few episodes, and in almost all episodes, the rapid rise in one particular investment category is always followed by a rapid fall. However, a properly diversified portfolio has been far more resilient than a concentrated portfolio, and resilient in two ways. Number one, on the way up, it does go along with the concentrated portfolio, but when the fall happens, the diversified portfolio falls much less. Having said that, the recovery does not come in the asset category which has fallen the most. The recovery comes somewhere else. And from that point of view also, after a fall, the ability to rise up again lies more with the diversified portfolio than with a concentrated portfolio. So let's say 2000 we had the tech bull run, 2005 we had the infrastructure bull run, then 2017-18, 2012 we had bull run in gold, 2017-18 small cap. So the hype keeps shifting, as you right. As Harsha was also mentioning earlier, and you also beautifully brought it out. So diversification can happen at 4 levels. Number 1, across companies. Number 2, across industries. Number 3, across asset categories. Now, these asset categories is where equity, debt, and even within that, long-term debt versus short-term debt, the liquid kind of category, gold. Now silver is also available for investment, international, and real estate. The beauty of the present times is all the asset classes are available in financial form as we speak today. For real estate, we've got REITs and InvITs. For gold and silver, we've got the exchange-traded funds. And anyway, the short-term debt, long-term debt, equity were always available. The 4th level of diversification is across geographies or currencies. So just to repeat, across companies, across sectors, across asset categories, and across geographies. That also is possible today sitting in India, that you can enter into international funds. Once you're diversified, then your portfolio becomes resilient. Now, a more prudent approach is to start with assessing the quality of the investments and then build a diversified portfolio. But the moment you are at an asset category level, diversification across asset categories is anyway taken care of to a great extent. Number two, when you are getting into a risky asset category compared to a safer asset category, you may define the upper limits. That, okay, let's say somebody says that equity is the riskiest asset category, and I'm not comfortable taking high risk. Fair enough. Only 25% of my portfolio will be in equity. I'll not allow it to go beyond that, which means whenever there is a hype, I'll be pruning my exposure down. One can do that. So diversification and setting those limits, that becomes a beautiful strategy for managing the risk. A lot of times people say that diversification brings down your average return. And you are 100% right. At any point in time, there'll be one player in the cricket team who would have scored more runs than the average of the entire team. But it's not the individual player that we are looking at. We are looking at the team's performance. And that is precisely what happens when you hold a portfolio. You got to focus on the team's performance. You want the team to, or their portfolio to be resilient, to be more consistent, rather than somebody, let's say, recently concluded Asia Cup, Asiad, where in one match, Yashasvi Jaiswal scored a century. In the very next match, he got out at 0. Right? So it happens with individuals. But when he got out at 0, Shubman Gill and somebody else Tilak Verma took over, and they won the match for the country. You need that. So don't chase that what is best. Spread across good investments, and the portfolio would help you reach your goals in a more predictable manner.
Thank you so much, Amitji. And I always love your cricket analogy, which can get much more understanding easier. It is as a team we need to win, not particular player century. It is not particular asset class giving a century. As your investment goal, you need to win if it is a match. And today is our World Cup, the first match, which is starting from Australia and India. Probably we wish all them the best. And it is the time of India has come in every part of it. Even in the Asian Games, we have crossed our first century plus medals. I think we are going up in the ladder. And it's a together India wins, together your asset class wins can make a difference. To put it in a perspective, a diversification, when you spoke, I understood one is diversification gives you a safety net, and you can accomplish your goals, not one goal and losing in one asset class. It is not bringing down your one asset and going up. The diversification all gives you the safety net, the first thing. And the one impact of one asset class goes to south, other asset class can go to north, so that you remain at the west, so that you can become the best of the investments. And that is the second takeaway which I can look at. And the third one is like the famous adage of don't put all eggs in your one basket, so that you preserve your eggs and the fall will not impact you. Probably I'll add from the mutual funds perspective. For one goal, one SIP, multiple goals, multiple SIPs, so that you diversify your investments. Taking this clue, I will go back to Harsh sir. It's Harsh sir, this is about the advertisements. This is about influencers, and there is about one is about the guarantee returns which we speak about and upfront about some things, and people will fall prey to it. And there is at the same time there is a huge opportunity people won't avail. There is an insurance which is available from the government of India. They miss the bus. There are sometimes some of the funds, even when I want to invest, there is a huge guaranteed return. Some schemes also good for me. And there are some questions which have come in, 2 questions which have come. One question which has come from Bhuban Barel is talking about what is the option to put retirement money for the monthly income scheme and which type of the mutual funds. Similarly, one more question which has come from Ms. Shalini Arora about the options for retirement corpus to get a corpus. Putting these 2 together, I can use government schemes. I will not fall prey to the guarantee schemes. I will not fall to the influencers. I need to maintain my retirement money. Can you give, one homeopathic pill to us understanding all this?
So my point is that if somebody says the word guarantee, right, please substitute it for low returns. Okay. If somebody says guaranteed and says double-digit returns, substitute it for fraud. Right? I think that's a very simple thing. there is no way on earth that a guaranteed return can be in double digits. It's not possible, right? So guaranteed returns are low returns, and low returns, the impact is it will not protect your wealth. Your wealth will erode because of inflation. It cannot give you returns that are higher than inflation. I think that is the real issue with guaranteed returns. Having said that, if there are government guaranteed schemes, and since the questions were around retired people, there is this senior citizen savings schemes, etc. The PM Vay Vandana Yojana has been discontinued. So senior citizen savings scheme is the only one that gives a 8.3% or 8.1% guaranteed return. But please remember, that also gives it only for 5 years, or 5 plus 3, 8 years. Post that, you're going to be living for 30 years, right? I think this needs to be looked into. People need to think about guarantee, please substitute for low, guarantee with double digit, substitute for fraud. If we do that, moment we do that, the power of mixing and automatic balancing that comes from, say, a hybrid debt fund, which has got, say, 90% debt and a 10% flavor of equity. Or if you are willing to take a slightly more risk, it's got 70% debt and a 30% equity. Or you got even more risk, you can have 50-50. You can have reverse, 70% equity, 30% debt. Whatever be your risk profile, the power of automatically balancing it is what gives it the power. There is no bias, it happens on its own, right? So when equity goes up, it sells off equity and buys the other asset class. When equity falls down, it has to sell debt and buy equity. Now that is so powerful. It's making inertia work for you. That's one. Second, for all the retired folks out there, one thing I want you to look at, people have this notion that I want my capital and whatever comes on top, I should eat, right? I don't want to eat into my capital. Who are you going to leave that capital for? Make up your mind, right? Because that capital is eroding. When you eat the income, your capital is eroding. Instead of that, why treat capital and interest separately? Moment you make it a bundle and you withdraw through a system, do the same. Withdraw through a systematic withdrawal plan. Okay. And it is so powerful both for tax reasons, because you're withdrawing a lot of capital, right? So the tax gets delayed. Sometimes it is much lower. And it is as elegant a solution as can be, because whatever is the equity portion in that goes up and down, and over a period of time, it is able to support. When you have a 25-30-year retirement periods and people are beginning to live for longer and longer, I think that is extremely important for retired people to understand.
Thank you so much, Aj sir. Indeed, we had a wonderful session with you on the retirement earlier. Probably very soon we can have one more session on the retirement planning, and probably I request our Manorama team to collaborate, and we can have next term one session exclusively on the retirement. And also probably we will discuss starting from NPS to various options available and how that retirement plan can be very effective. Thanks for that. And Amit bhai, just coming back earlier, you spoke about diversification, and Harshji spoke about equity, and we have ESG. But there is one asset class in mutual funds which is about the debt category, the fixed income category, which we tend to forget it. It's and can you narrate how the debt can fix into the investor, and what kind of approach it can help the investor in diversifying their investments and helping them to accomplish their financial goals?
So first of all, sorry. First of all, because it's a cricket season going on with the World Cup being played right now. I'll take that example. In a winning team, you will need an opening batsman, a middle order batsman, a wicketkeeper, a spinner, a pace bowler. So you will need multiple people with different skills. And that is precisely how you make a strong team. In case of investing world, you need different components. There are some fixed income assets, some equity assets, some commodities or real estate, etc. And that makes the resilient portfolio. That as an investment category is not talked about a lot, simply because there are some very popular investment avenues which are in the debt asset category, and people take advantage of that. Take, for example, a bank deposit or a PPF account or company deposits, debentures, etc., etc. Now, why not use only those, and why should somebody look at that mutual fund? So, first of all, the comfort of keeping money for a fixed term, keeping money at a fixed return, etc., is very luring. However, as Harshar was rightly mentioning, my investment horizon is 30 years, whereas the instrument that I have bought is maturing in 3 years. So the only guarantee I have is for the first 3 years, and there is no guarantee for the next 27. The returns would keep changing. We take this uncertainty without knowing that the uncertainty exists, simply because in the branding business it says jo dikhta hai wo bikta hai. In the investment world, jo dikhta hai wo darata hai. In debt funds, the NAV keeps going up and down. In case of a fixed deposit, there is no NAV, so the principal value looks like it's the same. So look at it from that point of view, that a debt mutual fund allows you the flexibility of removing money whenever your investment horizon gets over. So you can perfectly match your investment horizon with the debt mutual fund. You need not worry about. So let's say if my goal is due 3.5 months from now, I can invest in a liquid fund and remove money 1 or 2 days before my goal is due. However, for some reason, that goal, which is due after 3.5 months, due to various uncertainties of life, if the 3.5 becomes 5, what do I do for that 1.5 months? Well, nothing. The liquid fund will allow me to stay invested. There is no automatic maturity that I need to withdraw money. Or instead of the 3.5 months, if the goal falls due in 2 months, what do I do? Nothing. I can redeem. That flexibility is easily available in a well-managed portfolio. And by well-managed, I mean the credit assessment and diversification both come as a package within the debt fund. Credit assessment is done by the respective fund manager, diversification as per the regulation. The only thing an investor needs to keep in mind is, if the time horizon is too short, then some of the debt funds are not appropriate. If the time horizon is long, then don't go with the liquid kind of funds. Then look at corporate bond funds and PSU and banking fund, etc., which are meant for those kind of time horizons. Number 2, I'm so sorry. We all have highlighted one particular part, that once you follow your asset allocation, you need to periodically rebalance the portfolio. Now, this rebalancing is possible when the instrument that you bought or the mutual fund that you bought has liquidity. If I've invested money in PPF, I can add money to the PPF to an extent, but I can't withdraw prematurely to shift to equity. If the equity falls and my debt allocation goes up, I can't really shift money from PPF to equity. Liquidity is not available in many debt products. Debt mutual funds offer that liquidity on tap at any point in time. Third, there is a facility to do partial investment and partial redemption. You don't need to take out the entire money invested in that. So that's another flexibility that one can look at. And fourth, which is again not talked too much about, is on the taxation part. Now, the capital gains from debt funds is subject to tax, and it is at the same tax rate as interest income. The only difference is interest income is subject to tax every year, whereas capital gains are taxable only when booked. I mean, of course, I feel a little shy talking about taxation in front of her, sir. But that allows you, if your time horizon is longer, it allows you pre-tax compounding. Whereas in case of all the other debt instruments, the compounding happens at a post-tax rate. And that makes some difference over a period of time. So these are a few things that a lot of people don't talk about. And the final one is where the systematic withdrawal plans come in. You can structure your withdrawal in line with your specific need. If I've invested in a senior citizen savings scheme, the interest is locked for the entire period. But so if I'm a retired investor and gone to senior citizen savings scheme, my expenses are going to rise year after year. There is some factor called inflation. But the interest income will not rise. In case of systematic withdrawal plan, I can keep increasing my withdrawal as my expenses keep rising. So many of these flexibilities are often not talked about. It is worth considering that as part of the portfolio, not necessarily, I'm not suggesting that you should shift from the traditional debt to debt mutual funds, but there is a room for both.
Thank you so much, Amit bhai. And debt can play a very vital role for investors. When they are planning for their investment goals, you have rightly put it. It is also for, I can park for a 1 day into a overnight fund to make money out, or if it is a 3 months money, I am lying idle, it can go to the liquid funds. If I am having over 1 year money, 1 year money, I can look for money market or corporate bond fund or credit risk. Basically, debt funds invest in government bonds or corporate bonds or treasuries, and it's a broadly a debt investment. Thanks for this. And strictly, I will go quickly. Couple of questions now. Harish sir, there are a lot of questions which is repetition, which I'm avoiding, but there is one question which is a little deeper beyond the topic too, and which can be a concern for many investors. This question is coming from Sundari Jagadishan, and she was asking, are our markets are deep enough to absorb all the money which is coming now to the SIP through the mutual funds? And that FIIs are milking it periodically because of retail investors?
Wow, what a lovely question that is, Sundari. Okay. So indeed, today, and this is a very legitimate question. These are concerns that have been raised. $2 billion, 15,000 crores of retail, primarily retail, individual money coming in month after month. And we have seen some falls, not big falls, but we have seen falls. And it has been coming in despite those falls. And I think it is here to stay. Maybe there could be a little bit of up and down, but I think the retail investor has matured. What that has done is, obviously, it has pushed up. It has pushed up it has given us support to everybody, right? Initially, of course, the support goes to the strongest companies, but it's also now coming down to, because ultimately that money has to be invested somewhere. So I think the concern is right. Is this too much money? Are we sort of creating a bubble? Okay. And there is where our entrepreneurial class, we as a nation, Indians as a nation, because of we've lived under scarcity for so long. Scarcity is in our genes. Jugaad is in our genes. And we are entrepreneurs by nature. So I think we have enough entrepreneurs out there. Given the kind of capital market infrastructure that has now been created by SEBI, to sort of make sure that the not so good companies are not able to access the capital markets, I think that level of confidence has been reached. That plus this big class of entrepreneurs, I think we are going to see a virtuous circle of more retail investments leading to more entrepreneurs coming to the listed markets, leading to more retail investments, leading to more entrepreneurs. This is a virtuous circle. It is not a vicious circle. I would say there will be periods of time during which it will look as if too much money is chasing too few companies. But I think this is a self-correcting cycle. But this is a lovely, lovely question, Sundari. All the investors out there, this momentum that we have created, please remember, when those entrepreneurs out there, yes, they are the unicorns, they make the money. But remember who benefits? It's the country who benefits. It's the millions of people who are employed, people who use their services, customers who are now getting those services at a lower prices, faster, more efficient. It is India that benefits. It's the world that benefits. So I think this is a superb virtuous circle that has taken place. It has, and kudos to the mutual fund industry, kudos to AMFI, kudos to you, Rav Garu, and all your colleagues across the industry for this wonderful environment that has been created. And obviously, kudos to SEBI that they have created this kind of a confidence in the market, that retail investors feel confident. And mutual funds is the absolute right vehicle through which retail investors should invest, whatever be the asset class. Whether it be debt, I cannot think of why any investor will not invest through mutual funds. Let it be somebody who wants to invest 500 rupees a month to somebody who wants to invest 50 crores a year. Okay. For everybody, mutual fund is absolutely the right vehicle.
So much, sir. Amitji.
Just to add to her point, when we look at the total AUM, the assets managed by mutual fund industry as of end of June, it was around 45 lakh crores. So obviously there is a question, but roughly 10 years back, I faced a similar question. Isn't the mutual fund industry managing too much money? Are we becoming too big to remain manageable? So I looked at the data. June 2013, there's the total assets. Today we are at 45 lakh crores roughly. I mean, today this is June 2023. June 2013, it was 8.5 lakh crores, and we had the same question. June 2003, the industry was 1 lakh crore, and we had the same question. So keep asking those questions. It keeps the industry in check. Brilliant question. We'll need to, all of us need to behave responsibly, because as Harsha was mentioning, this is a virtuous cycle. And if the virtuous cycle keeps feeding itself, we are becoming a powerful nation. And as the Spider-Man says, with great power comes great responsibility. And if we don't behave responsibly, then investors like you have full right to ask those questions. So thank you so much for this question.
Fantastic. Thanks to both of you for giving that clarification. And it's all, markets are expanding, economy is expanding, then you have an absorption, you can take that. It's to put it typically, you have taken the 2003, 2013 and 2023 AUMs of the mutual fund industry. If you can go back to Indian GDP itself, the first trillion of GDP has come to us at 67 years after independence to us. And second trillion of GDP has come after 80 years from there. And third trillion of GDP has come after the next 5 years. Means, that accelerated pace of growth, and there is a power of compounding and collective effort and economy expansion that can absorb. I think we are moving from the developing economy to the developed economy. We have a huge scope to accept it. There is not a smaller market, it is a wider market. However, participation, now it is becoming bigger and we can do. And quickly run through other questions, then we can sum it up very quickly. Maybe another 10 minutes, sorry gentlemen, for both of you, and little 10 minutes extra we will run. Audience, please wait for it. And there are, on the chat box, we have provided lot many links. Please download, as much as possible, and you can read at your leisure. You can give it to your family, have a discussion. This is the general literature which can make very differently. Whether it is a SIP, whether it is a how to handle the market, how to record your own financial journal. These are the books available to you. Come to our website, you can get, and some of you have asked, I think Mr. Satya, you have asked where to revisit the video. Currently, this video is available on the week Facebook channel, which is on. We have a little over 4,000 odd people who are watching it at this point of time. Later, it will come to the YouTube channel of us. You can look at this video. And some of you have asked for the PowerPoint presentation. Honestly, on the video itself, it is there. You can download, you can take a screenshots. It is right. And Satya, there is another question which has come from the foreign REIT funds. Probably in the next session, we can do differently. Currently, invest in what you can understand. Smart investor is the one who invests what he or she understands, not what he or she doesn't understand. You have a huge scope to invest. And Mr. Barrel, thank you so much. We will be doing separate exclusive retirement session very soon, and we can talk about mutual funds and non-mutual funds. Broadly, retirement as a theme, we can rerun once again. And this is a question which is coming from Mr. Korat. This is regarding your mother's investment. Probably it is very inappropriate for us to address without understanding the situation where to get return. And earlier, Harshji spoke about some returns which you can get, guaranteed returns from the post office monthly income stream, government senior citizen scheme. Probably you can explore that, then you can come to the mutual funds. That could be the better option for your mother to make it simple, make it available, make it next door to you. And Mr. Satya, we spoke about debt default. We can talk about. Mr. Abhay, regarding PPF and NPS, please do join us in the next retirement section. We can do it. And Mr. Madhusudan, you have mentioned about we are broadly, the panel is tilted towards equity. Honestly, neither we tilted to the equity nor we tilted to the debt. We are tilted to the asset allocation. We are tilted to the advisor. We are tilted to the investor. And that's the whole intention for us. Thanks, Sundariji, for your comments, for your positive message. Thanks to each one of you for giving a lot of encouragement to us. On the capital gains, I think it's an elaborate one. Probably we may not touch in the last minute now, and which we can do. And Mr. Ajay Ahuja on the PMS, why PMS is not encouraged. We are not saying encouraged. That can come to a later stage. When you are a evolved investor, you can look at PMS. I am talking about generic investors. And Mr. Bhuban, this video link will be available through mail. If you want, we can share definitely, but it is available. We can share it with you. Definitely, you can write to us. I think with this, we have answered as many questions as possible. And some of you have asked about the courses, etc. And please follow my friend Amitji's Twitter handle. He can guide you a lot on what kind of courses you need to understand. He is a professor in himself, and recently he is into a big academy which started one step at a time. He can guide you what is that one course you can take. Now, the last one question for each of my wonderful panelists. Start with Amitji. Amitji, before we wind up, there is a question for you. What are the broad common mistakes investors, especially retail investors, will make? And what is that you can advise them?
The first common mistake that a lot of us make, and something that both of you highlighted, is jumping in without proper homework. So take your time to understand, and before you sign that check. Number two, believing in somebody's false promises. Harsh sir gave a beautiful formula for not losing. He says, if there is a guaranteed return, it is low return. If somebody is guaranteeing high return, then it's a fraud. Please understand that. I think that's a very good rule to remember. Number three, your short-term success in a particular investment could be largely on account of luck. Don't take credit for that, and don't start assuming that now I know everything. People who have spent 30 and 40 years in capital markets still consider themselves as students. And if you remain students, you will never ever take a decision without proper research. Take professional help wherever you think you are not fully equipped. Now, simply by taking professional help, your problems will not get solved. You may get Krishna as your Sarthi, but you've got to be Arjun to deserve a Krishna. Ask the right questions. Don't simply go because somebody is your advisor. Let the advisor also answer whatever concerns you have in mind, if you don't understand, there is no hurry. There is absolutely no hurry. All the good financial professionals talk about the virtue of patience. If patience is a virtue, the financial advisor cannot be in a hurry to get your check. Finally, some of the learned and successful investors amongst you, the biggest mistake that you may make, and I'm not saying you are making, you may make, could be overconfidence in your own abilities. These are some of the common mistakes that I'm looking at, apart from the standard emotions of greed and fear and hope, etc., that we talk about. But these are some of the common mistakes that I think one must think about.
Thank you so much, Amitji. I think Harsh sir, I missed it. Harsh sir is, Harsh sir, are you there? Yeah, I think before Harsh sir is coming in, thanks. When we will conclude, I thought I'll have a final word from Harsh sir, and we will invite Matthew sir back on the stage. And then, friends, thank you so much for taking time out. And it is wonderful knowing everyone. And it's a great session to have both of our panelists, amazing panelists, and lot of earning. Probably I say SIRI, like it is a. I think I'll add. Matthew sir, I'm unable to see you here. How do I get you there?
I'm here, sir. Harsh sir is also up there.
Yeah, I think it's yeah. Now I got you. And,
yes.
Yeah. Sir is muted probably. I mean, he will join in case we will do. And thanks to the audience for your wonderful questions. It is and we talked about smart investing and responsible investing. I called it as a SIRI, the Siri in. I mean, the Siri is the one which you use for your Apple iPhone as an assistant. Or Siri is the one. It is your wealth in Indian context which we talk about. And that Siri will come to you only when you have a SIRI, when you are staying invested and you are rebalancing your investment at a periodical type, and your SIRI could be a sustainable investment, and which is and systematic investments, and which can be a regular investment. And with these two gentlemen, fantastic. And for me, that smart investor is the one. Today's definition could be investing for the sustainable investment, managing the volatility, asset allocation, and risk versus return, and timing in the market. And finally, when Amitji was talking about what to avoid, what to take, I mean, probably I can take the clue from Amitji is have clear financial goals according to invest accordingly. Think for the long term and invest for long term. Diversify your assets and choosing a right mutual fund for a right goal, and embrace the mindset where you can be investing perpetually and investing for long. This is the key takeaways as a World Investor Week, and wishing you all the good luck and happy investing. Next session, we will come back with a different theme and with a wonderful speakers around. And thanks once again for joining us on a Sunday. Over to you, Matthew sir. I think I miss Harsh sir now.
Yes, sir. Harsh sir is missing now. Thank you so much to all our viewers for logging in on a Sunday. I hope this has been of great interest to you. You are what keep us going. Without you, we have no reason to be here. So thank you for logging in Sunday after Sunday, and thank you for the questions as well. Somebody asked for Amitji's Twitter handle. It is Amit M Trivedi, at Amit M Trivedi on Twitter. Please do follow Rao sir also. It's also a wonderful experience. Harsh sir is also on Twitter and easily can be found. Thank you so much. Let me wish you a wonderful Sunday and what is remaining of the weekend, and a wonderful week ahead. Happy Investors Week. Thank you from the week and from ABSL.
Thank you.
Yeah, thank you so much. Thanks to all of them who are at the back end for us, Mavina, Anand, Sridevi, Rahul, and thanks to the entire team of Manorama helping for this to happen. Uman sir and Sri sir, and thanks. And indeed, it's a fine Sunday to spend, and God bless you. This is a period of Pitrupaksh still on. It's a period of gratitude. Please do contribute to the society, whatever you can do, apart from contribution to yourself. God bless you all. Thank you so much.
Thank you. Thanks.